recording, you're not recording on the board, are you? Don't put those hands up. Jeez. Can't take you anywhere.
That is very true. But I can count. 3, 2, 1, and we are live. Welcome to G Money, real talk on everything mortgages and real estate. Today I'm here with Sarah Abrams, and we're going to talk about
the HELOC.
The HELOC. We're going to talk a little bit more than just HELOCs. We're going to talk about second mortgages in general, but specifically, most of the conversation will be about HELOCs.
Also known as long form
Home Equity Line of Credit or Line of Credit. HELOC, acronyms. That's what we do in the mortgage world. So welcome. With that being said, HELOCs are becoming more and more popular. As you heard various names, people call them slightly different things, but they're all the same. And what are they? And why, hey, we'll shoot you straight. Good, bad. What are the pros and cons of the HELOCs? So many people that purchased a home or were able to refinance during the COVID era, refinanced into extraordinarily low interest rates. And so they don't want to, if all possible, refinance again. But what is another viable solution to tapping into the equity? And so to do that, that's the HELOC, whereas you can go into second lien position, keep your grandfathered in beautiful refinance or purchase loan, and then this HELOC goes in as a loan behind it. And so you're able to access the equity. And, just as I'm going to say a historical summary, they're very easy loans for well-qualified buyers. And that's kind of the origin of how they started. They have evolved, and we're going to talk, not only just the cream of the crop rates and programs, but we'll dive into some of the expanded guidelines and credit terms as well. But the thought was, again, if you're a 740 credit score and you have, a really low loan to value on your first mortgage, that they wouldn't make it extraordinarily difficult for qualifying. So historically, they like to see 70% combined loan to value. So again, we're kind of adding some new terminology. It's, okay, we have loan to value. If your first mortgage is $200,000 and your home is valued at $1 million, you would, what's loan to value? Divide that loan amount into the value, and in that example, it would be 20%. Combined loan to value, we want to look at the total exposure of any and all loans on there. So if you have a first loan at $200,000 and we're proposing to do a second loan at $200,000, combined those loans are $400,000 divided by the $1 million value, that would give us a 40% combined loan to value, or CLTV. Okay. So historically, they like to see in standalone transactions a 700 credit score or greater, 70% combined loan to value or lower. And with that, and obviously there's more and more programs becoming available, they've opened the door on that. And so we do have equity lines that go up to a combined, for rounding purposes, I say 90% CLTV. The technicality is it's 89.99%.
That's fun.
Yeah. Why do they do that? I don't know. It just makes for a good conversation. But for rounding purposes, and there's my little asterisk right there, I've given you that the technicality is the 89.99. For rounding purposes, our conversation is going to say 90%, that we can go combined loan to value up to that. Now, with that combined loan to value, yeah, you need to have, a 700, 720 or greater. They're looking for well-established credit. Now, we do have some of the equity lines that, again, credit parameters, they'll go down to a 640 credit score. You're just a much higher risk. And again, everything higher risk equals higher rate. So you're going to pay a higher rate. Now, let's just talk about the HELOCs. How they work is it's a line of credit. And so the easiest understanding is like a very large credit card tied to your house. If you have a $200,000 line of credit, then that doesn't mean that you necessarily have that money borrowed. You have it available to borrow. Okay. Now, if you have $100,000 borrowed of a $200,000 line, you've used 50% of that, and your minimum payment is based upon how much you have borrowed. Okay. So again, that credit card concept, borrow, repay, with that, whatever the balance is, then that's how much your payment is based upon. So with HELOCs, we get into certain terminology, and that we need to understand is it's ours. Now, everybody's a little bit different, so I'm going over ours of the parameters and the details. These are questions as you're looking around. Credit unions are a really good solution for a lot of HELOCs. I will be honest that most credit unions, they're lending their own, funds. And so they're very conservative with their guidelines. So most credit unions will not go to a 90% CLTV. Okay. They like the 70, maybe 80%. Their rates are good. So again, as you're shopping around, here's the things that, I'm going to say that you need to kind of look into of what are the terms that are best for you. One is, how long is the overall HELOC? I'm going to say amortize, but that's part of what the questions go into. How long is the loan? So ours, for example, is a 30-year loan. Now, how long is the draw period? Now, all of these will have a shorter draw period than the actual loan. Some of them go as high as 10 years. Some of them are as short as 2 or 3 years. Ours is a 5-year. So what does that mean is that you can draw and repay as many times as you would like for the first 5 years. That is the draw period. At the end of the draw period, then they take what your balance is and they amortize it over the remaining 25 years. Okay. Now, again, look into the terms that you're being offered, because many credit unions will not do a 30-year loan. They'll do a 20-year loan, or they will do a 25-year loan possibly. Now, with a 20-year loan, let's just play devil's advocate. You have, let's say, a 5 or even a 10-year draw period, and then you go into a 10-year repayment amortization. That's where they apply principal and interest to fully repay the balance. What does that mean is that your payments are significantly going to jump up.
Right.
Okay. The other thing, and again, there's a lot of details with these, is most of these, and ours inclusive, has it during the draw period that your minimum payment is interest only. So how much do they, each month you have $10,000 charged, it could be a $200 payment. That's just applying towards interest. Now you can apply as much towards the principal as you would like, but the minimum payment is just that. Now, it's also very similar to a credit card. If you look at your mortgage and you have, predetermined, it's an installment, whereas, 30-year fixed loan, you have 360 payments, 359 of those are identical. And typically the final payment is a few dollars less, a few dollars more to balance everything out. And they base that upon a 360 or 365 day calendar year. The HELOCs are again mirroring the credit cards where they look at your billing cycle and what is the interest rate, but how many days during that billing cycle. So, for example, you may have $100,000 charged in the month of February. You may have $100,000 charged in the month of March.
They're going to be different payments because there's different amount of days in the month.
Exactly. And so, again, these get very technical, a lot of little nuances, but that's because you're paying per day that you have that dollar amount borrowed. And it's also, as I get into it, all of the HELOCs are typically, I say all and typically, it contradicts itself here. A majority of the HELOCs are also adjustable loans. Now, comfort-wise, everybody loves that security blanket of a fixed loan. Typically, to get into a fixed product for a second mortgage, it needs to be what they call a HE loan, a home equity loan, where you have to draw everything at once and then you can fix it and then you can immediately, make the same payments each month.
So the difference, though, to clarify that,
Yes.
HELOC, you're only making payments in the initial draw period based on what you've actually drawn. Where the HE loan, whatever your loan is, you've drawn all of that capital, and now from day one, you're making payments.
You got it.
Okay.
Yes. That is pretty standard in the industry of how they work. Now, you've been trained over and over again that, again, we like this security blanket of fixed. I will share, every, season of time is different, but right now having the adjustable is an advantage. And that's probably for the next foreseeable few years, 3 to 5 years. Historically, how they work, and anytime I just want to kind of explain adjustable loans here, is you have, how do we determine what is the actual interest rate, right? We have an index, and that is what is adjustable. So where does that rate adjust is called the index. Okay, so what market are they basing the interest rate? Where is the bank obtaining the funds? And that is going to be on the prime interest rate. Okay, presently prime is 7.5%. So if that's what we as a bank pay for that, then we're going to add a margin or a profit margin for us to make some money in addition to that. And so the margin varies by credit score and also combined loan to value. There's a few other factors that go into it as well. But as you're hearing, how do we determine the rate is prime plus margin equals the rate. So as a perfect example, right now it's 7.5% prime. If we're at 70% CLTV or less with a 760 or higher credit score, we are at a quarter margin. Okay, so that means your interest rate would be 7.75. Now, the prime and HELOCs, this prime rate is one of the very few exceptions. It's the only exception in mortgage rates that is directly linked to the Federal Reserve. So it's all over the TV and the media whenever the Federal Reserve meets, and they meet about 8 times per year. They're deciding on the monetary policy for the economy of the United States. Do we raise or lower rates? The rates that they look at are very short-term in nature, right? Banks borrow money from other banks borrow money from the government, et cetera, et cetera. And so they're trying to stimulate in immediate shifting of rates, how that will stimulate or slow down or whatever they're trying to achieve in the economy to make a direct impact. So when we're talking about a 30-year mortgage, I get this all the time. Hey, the Fed just met. They lowered rates 0.5%. Yes, they did, but that does not apply to the 30-year mortgage. And actually, consequently, at the time that they're meeting, we get a lot more feedback where the rates actually go up on a 30-year mortgage, even if they lower them on the short-term side. And it's just counterintuitive, but also, it's indirectly fed into the long-term mortgages, because rather than looking at increasing or decreasing the rate, yes, there's anticipation built up to that, but they're wanting to see the speaker afterwards. Hey, what is their comments? What is their belief? What is their direction that the economy is in? And that's more or less the big game changer, is the comments and the feedback after they make the rate changes of what to do. So there's a lot that goes into interest rates. With getting a little sidetracked here, it's also important. Why did I do that? Is to give you kind of the background, but also why did I suggest that having an adjustable rate is really good right now is we're at, I'm going to say, historically high point in time, whereas prime is higher than it typically is. For many years, prime sat in the 3 to 4.5% range for several years in a row.
So hypothetically, if back you referenced it as the COVID era. So in COVID era, a HE loan would have been potentially more advantageous, because if they locked in a loan in the 3s, because the rates would have only gone up during an adjustable, but you're proposing that right now, the rates are in a position where they're at some point, typically, I guess the forecast is saying they're going to go down. So if you do it adjustable, your rate would go down versus going up.
Correct. And that's, again, where I'm alluding to is with the Fed meeting 8 times roughly per year, there is speculation, high probability that it's predicted that the Federal Reserve will reduce the interest rates 3 additional times this year. So 2025, we have 3 opportunities that those rates, not guaranteed, but there's a good chance as of now that those rates will come down. And so what does that mean? Again, let's go back to your bill. You're on we're in May 28th, and today they lower the rates. You would have 28 days borrowed at $100,000 at 7.5%. Well, plus your margin, 7.75. And then if they lowered it 0.5%, you would have 2 or 3 days of, 7.25%. So that's why they do it daily interest, is if there's changes within that billing cycle, then you're billed, charged accordingly. It gets a little complicated, but it's actually quite, easy once you have one, you understand. Now, the pros and the cons, again, it's easy access to capital. We've been increasing the limits that we have. We can go to $250,000 line of credit without a full appraisal. We do a desktop appraisal, so that's streamlined, that's easy. If you want to go higher, we can go up to $500,000, and that number has even been raised with 720 or higher, where we can go potentially up to $750,000. So you're getting these larger and larger lines of credit. Now, the pros, they always say get money when you don't have it.
When you don't need it.
Don't need it. Thank you. Man.
I got you.
Thank you. See, that's why you're here. Oh, not only you look great, you keep me in line. Thank you. Okay. Get the money when you don't need it. And that's exactly it is, if you're struggling, your income's impacted, you're having hard times, it's going to be more challenging to obtain that. Your income's good, your credit's good, things are going well. Get the line of credit. They're very cost effective. And so if you don't have anything charged, you don't have any payment on that, but let's just say there's a huge opportunity that comes along, you can write a check off of your line of credit, deposit the check into your account, and you could go pay cash for an investment, whether that's a piece of property, a small house, a rental, down payment on a rental, whatever that opportunity is, you have access to your equity to quickly jump on that and to help. So that aspect is very excellent. Another advantage here, again, you don't have to tap into the fixed mortgage that you have that's already an extremely low rate, right? Some of the challenges I will say is, if you're going to obtain a $500,000 line of credit here, long term is, and you're going to max it out, is that the best loan to get? Not necessarily, right? Because it's in second lien position, because you're going to use it and max it out. There's going to be easier and better ways, more than likely, to strategize maybe on a fixed product like the HELOAN, where you can get a fixed interest rate and you can start repaying it right away. So long term, I'd say I always suggest having an exit strategy. If you do utilize it, how long do you have the line before you refinance or do something else? They're not really meant for a 30-year loan, being honest. Now, again, you've heard they're not meant to, because truly they have a draw period. So you can only charge on them, whether that's 5 years or 10 years that you're drawing on. And after that, you're just repaying it, and it becomes more of a traditional loan. So is that rate in line with the market? Is it higher? Is it lower? Is it better to consolidate the loans? At some point, there may be those opportunities.
Yeah, I was just going to ask that, like later down the line, 10 years, 12 years, whatever. Could you consolidate the HELOC into a refinance and consolidate it?
Yeah, absolutely. Yeah, as long as you have the equity. Values for the most part are increasing year over year, but not to say some markets. I'm reading a lot right now about Las Vegas and kind of the overbuilding of that area and how many new homes are in there that they have many price reductions. And so, again, some market areas are going to have more volatility in the values. So just because you bought it at $800,000 doesn't mean it's worth that a year later, speaking to Las Vegas area. So that's kind of that. Again, contrast the HELOANs, where you get into the lower credit scores. That is kind of the preferred methodology of how they set you up. So if you have a 640 credit score, yes, there are some HELOCs, but they're going to be much higher rates than what the HELOANs are offered at. Excuse me, a little cough itch there.
Do you need some water?
Yes, thank you. Okay, so what else do you have question-wise on the HELOCs? What did I not cover that's coming to mind?
So if, let's just say a couple comes in, they're both on the primary loan. Do they both have to go on the loan for the HELOC or the HELOAN? Does it have to be, does title have to match, or does that, I don't know, does that impact anything?
Yeah, let's speak to that. So we are licensed as American Pacific in several different states. I'm licensed in several different states. Majority of what we do is California. So I'm going to speak to California because that's, primary business that we do here. So I'm just specifying there. California is a community property state. So what does that mean is you can apply together or you can apply independent of your spouse. For government type loans, the government loans do require us to take into consideration the spouse's liabilities, as we're liable for 50% of all debts incurred, during the marriage. Now, for conventional and products like this, we do not. So I also want to specify here, we have two different components whenever it comes to title and application. So we have title, which is the pink slip to the home, and you have husband and wife. You have Greg and Sarah Abrams on title to the property, okay? Now, both of you own it on title, but just one of us could be on the loan.
Okay.
So that could be, Greg Abrams is on the first mortgage and Greg Abrams is on the second mortgage, but both you and I are on title together. That's clearly acceptable. So you have your choice there, which is nice, offers some flexibility. Always consult, especially more and more, an estate planner with vesting, how critical that is as you're acquiring assets. Can't recommend that enough to make sure that you're getting legal counsel of how to hold title. Mm-hmm. That makes a big difference, especially if something were to happen to one of the owners.
Yeah.
Yeah.
Earlier you had mentioned, the benefit of having a HELOC is having the capital when you want it. not necessarily you need it. And then you talked about using that, like if an opportunity came up, to buy an investment property or whatever. Do the funds that you have through the HELOC have to be used for real estate? Because
No.
all of the examples you alluded to had to do with the real estate. The cash is cash. It's yours. You can spend it however you want it, correct?
That is correct. Yeah. I mean, if you wanted to go purchase a vehicle, you could.
Right.
Now, do you want to finance a vehicle over 30 years?
Right.
I don't think that's the wisest choice, but you are correct. Yes, the funds, once you deposit them in, how do you draw? Typically, there's two different methods you can use, like a check card type thing where it has a Visa or MasterCard logo and you can draw on the account. You can go to Home Depot, buy building supplies. Of course, the idea or the concept is you're using your equity in your home to improve your home, to improve the overall value. But that does not limit you, or there's nobody there to police you of where you actually spend the funds. So whether you're, using that card or check to, again, purchase a vehicle, that's up to you of how you want to spend that.
Yeah.
Now, some of the other, and recently we've had some workshops, other things of, ADUs have come up, construction loans have come up. And so as we go through some of these solutions, and let's just take an ADU, for example, where it satisfies a housing need, whether you're trying to get more rents out of your home or just, you have a multi-generational family and you need to provide more housing within your home and don't have the space. ADUs are becoming, more and more readily and easily available to build on your property. This is a really good solution for something like that because, again, as long as you have the equity where it stays within that 90% combined or less, you have the discretion to spend the funds how you want and on what you want without any oversight. Meaning, if you are building an ADU, you control that. The same goes with a cash out refinance. So if you had a first mortgage that you wanted to do the same type of thing, build an ADU, you hire a contractor, you guys work out the terms, you can do that. Where it gets highly regulated is if you're trying to do a rehab, remodel, or even just a true construction loan. In those dynamics, we're able to lend to the future value. So the first two loans, the HELOC and the traditional refinance that I'm suggesting, that is on present value. Your home right now is worth $1 million. You can go up to $900,000 combined, and we can, do a HELOC. For a cash out refinance, we can go up to 80%. So that would be $800,000. Let's say you need $1 million. Can we get that for you? We can, but then we would have to do it for a construction loan. And why is that? As we look at, if you were to add this ADU, your home right now is worth $1 million, but with the ADU, the future value, once it's completed, would be worth $1.25 million. Mm-hmm. We can do loan to values based upon the future value. So there is a good chance that we can get you the $1 million or really close to it by doing a construction loan.
Got it.
Now, this is where, reality sets in that many people don't finish projects, just drive down any street. And you see from vehicles to houses and all kinds of projects in between that don't always get to the finish line. As a lender, we have to mitigate that risk. So when we do a construction loan, when we're based upon future value, we're going to do everything in our power to get that to the finish line. Okay. So we're going to do vetting of the contractor. We're going to help you. We're going to make sure that he's licensed, he or she. We're going to make sure that they have the proper insurance requirements. We're going to look for other projects that they've completed to make sure that they've their diligence. We're going to check and make sure maybe, it depends upon how deep of vetting, but, obviously if we do anything government related, there's a lot more requirements. So the vetting there is that, they look for, has the contractor filed bankruptcies and Do they have any liens or judgments against themselves? So it can be pretty rigorous, but again, it's for the protection of the consumer. The other thing that we do when we do the construction or remodels, we set up a draw schedule. So the contractor doesn't get a lump sum of all of the money up front. They have to do a certain, up to a certain point, frame it, benchmark, exactly. Then it gets inspected by a third party to verify that it's completed, but also completed in a workmanlike manner. And then they'll release that draw or those funds for the contractor. They do that all the way through the process, again, to the finish line. And that's how it works. So, again, just kind of elaborating on some of the possibilities or the differences or different scenarios where you would look at, where is a HELOC advantageous? Hey, if you have the equity, HELOC can be a lot more advantageous. It can save you money on that construction loan. It can save you money on the construction fees, but you have to be the moderator to do all that. So it's just kind of more or less food for thought.
And I guess on these too, so like, what's the turnaround time? Someone's not going into escrow, or it's a 30-day escrow period. So how quickly can someone get a HELOC done? Is it different with a construction loan?
Yeah.
And what are the time frames on starting and ending and finishing that up?
Yeah. So occupancy plays into any loan. So if it's a refinance of a primary residence, a HELOC on a primary residence counts as the same. It is a refinance. There is a 3-day rescission period, which means once you sign the loan documents, the formal loan commitment, we give you until midnight of the third night to cancel. Make sure that you've reviewed the documents, that you still want to proceed. We, as a lender, are in a holding pattern for that time period. We cannot fund it until the fourth day. And then we fund it and record it, and that's when we close. So on a primary residence HELOC, if you're $250,000 or less, where we don't need a full appraisal, again, that saves time and money, then we can close a HELOC in a few weeks, 2.5, 3 weeks tops. If we have to have an appraisal, obviously that adds a little time. I'm going to say about a month or less, times that we can push it a lot faster. Just depends upon, volume and market, things like that. The same goes with a refinance. And then when we get into the construction, whether it's a purchase or a refinance, that's going to be kind of, I'm going to say a minimum 45 to 60 days. When we do the construction, again, we're talking about this future value. How do we determine that future value? Well, you have to get the design, the concept, the bids all gathered up together. So you have to go and paint the picture, provide all the estimates to the appraiser and say, look, we're adding on 1,000 square foot ADU. Here's the materials that it's being made out of. Here's the countertops it's being made out of. They have to have something to base that future value on. So you need to have the bids and more than likely the plans in place to be able to do that. So it takes a lot more time and energy really just in that upfront process to do the loan. And that's why I'd say 45 days minimum, if not 60 days. Now, the other thing, just kind of going back to some of the compare and contrast or nuances of the HELOC, is they're not just for primary residence anymore. And historically, it was primary and secondary or vacation homes. We are seeing more and more opening to investment properties. Okay. Now, again, we can do them, but there are higher rates. So in the margin, you're going to have a higher margin based upon occupancy, and investment definitely has some higher margins in there. Okay. Mm-hmm. With ours, there's two things that are common on all of these equity lines. And one is a prepayment penalty, or they don't call that, they call it an early closure fee. Ours does not have that. Now, why do they have that in some cases is some banks, some credit unions will do like very low fees or no fees. But if you cancel it before a certain amount of time, then they want their money back. Okay. So ours, you pay your fees up front. You know, there's a small lender fee, there's title, escrow, and recording fee, and then depending upon whether or not you have an appraisal fee. So you pay those fees up front. They're based upon the line limit, right? So if you have a $250,000 line of credit, obviously the fees are less than $500,000, but you pay those. You pay them directly to the vendors. They're modest premiums that you will incur, but because you're paying those, yeah, we want to make money on the interest, but we're not going to penalize you if you want to cancel a loan within, 3 years. You can do that, and there's no penalty to do that, whether they call it a prepayment penalty or, again, an early closure fee is typically what they say. So that is the case. The other thing that we have, which most do as well, is an annual maintenance fee. Really that's only during the draw period. It's really whether you have checks or you have a debit type card that comes out of your account. It's to cover the cost of some of those maintenance fees. That's all that is. They range from $75 to like $150 a year. It's not make or break in the grand scheme of things here, but just kind of noting, hey, these are those details that you should be asking. Is there an early closure fee? Is there an annual fee? Is there a minimum draw fee? And this is also something that's becoming more and more prevalent where, you have a $250,000 line amount. The bank is wanting to encourage you to spend that money. So they do, require, and ours does require a minimum of $50,000 that is drawn. Now you can immediately repay it immediately. It's about a week, I just had a client that did that. We did a $100,000 draw and she paid that back in 8 days, I believe. And that includes the weekends. So she only had 8 days of interest, right? So, why did she do 100,000? She was able to get a better interest rate, a lower margin by having that initial draw. So although she will have that, short-term interest that she paid, overall it made sense to long-term have the better interest rate on the whole line than just the short interest.
Yeah, that's something to think about.
Yeah. So you're hearing a lot of things, minimum draws, early closure fee, how long is the amortization? How long is the loan? How long is the draw period? Most of them all should have interest only. How long is that? Or is this a 5-year interest only, 5-year draw period? So it's when it goes to the repayment, that's when it goes principal and interest during the repayment period.
Yeah. And then I guess just for me, just like as the consumer, like how easy is it to get the cash? How quickly? Like you had talked about checks, then you also said something about a debit card. Like, are there options, or is it kind of how does the consumer get their money and get someone paid, and how quick is it?
Yeah. So again, typically there's two options that you could have. One is a Master or Visa card wherever they take those that you can charge it, like at a Home Depot. That's instant access, right? The other is checks. Now, depending upon your banking relationship and also the size of the check, if you deposit a $100,000 check and that's atypical to your spending pattern or cash flow, there's probably going to be a hold on that. So you need to account for what is your bank hold. 10 days, I think, is some of the max that I hear. Now, they release some of that money within so many days, so it can vary, but I would say up to 10 days, be prepared that, some of the larger checks take to spend on that.
Sure. Okay.
Now, as far as the repayment, you do have online access that you can go online at any time. You can check your balance. You can also make principal payments directly online at any time. It's not just, it's minimum once a month, like a traditional creditor, but you can pay extra at any time.
All right.
Yeah. So I'm just trying to think of any other highlights here. I talked about in second lien position, if you have your home paid off, you can even do a line of credit or a HELOC in first lien position. So,
And why would you do that? What's the difference?
well, again, and let's just talk about this is first and second lien position. The position that you're in has to deal with risk. Okay. So I'm going to go kind of rewind back to the foreclosure era. We're going to put ourselves in 2008. Many people did 80/20s to get into their home. So they bought a $100,000 home. They did an 80% first mortgage. They did a 20% second mortgage. Why did they do that? Was to eliminate mortgage insurance, kind of the workaround at that time. But you have two loans and you financed 100%, right? So if that person goes into foreclosure and has financial difficulties here, a lot of times the seconds were wiped out or they got pennies on the dollar because you're in second lien position. So who forecloses makes a difference. And so I know this is kind of getting really sidetracked, but it's good to understand or know how it works. If you're in second lien position, you had that $20,000 loan and the borrower stopped paying you, in order for you to be the loan that forecloses, you would have to make the payments on the first mortgage to keep them current and for all the foreclosure proceedings to be under you in the second lien position. Well, most of the time that doesn't make financial sense, right? If you're only 20% of that, you're a smaller loan, you don't have the financial capability to make the payments of the 80% loan, plus you're already out your 20%. So a lot of times you let the first mortgage foreclose on the property. And then the first mortgage truly doesn't really care about you as the second mortgage. Let's be honest. They're just trying to recover their debts. So whatever's left over beyond their debts goes to them. That could have been $1,000. That could have been $5,000. And the second, a lot of times, would accept that just to get something recouped and to move on from their loss. So position does not have to deal with dollar amount, bringing that back. It deals with how do you know who is in first or second lien position or what position is by the recording date. So a first mortgage, you have a loan, you bought a house, you did a loan. That is in 2024. Then you come to me in 2025 and you want to do an equity line. Because the date, that 24 loan is still there, we're now recording a new loan in 25 in addition to the loan in 24. So that's what creates it as second lien position. Now, here's something to understand, and this gets a little complicated. Let's say you have a first mortgage and a second mortgage, and all of a sudden you want to refinance just the first mortgage. You don't want to reapply for an equity line. You don't want it closed. You just want to keep it, but you want to either increase, decrease, whatever the reason is, that first mortgage that you have. It is possible, but you have to do what's called a subordination agreement. And so basically you have to, as the new lender, we're doing the loan, we have to help the borrower fill out these forms to go to the second mortgage and say, look, we want to do a new loan that is superior to you. You have to ask permission. So they're going to want to know, are you increasing the loan amount? What is the interest rate? Is that increasing or decreasing? They want to look at the risk. They want to see the appraisal. They want to see the documents as well. And so again, why do they do that? Is they want to make sure that you're not going around them to lower their risk of getting the money back. And so you have to ask permission. And this subordination always takes time and it takes money. So that's something to be considerate of as well. I've seen them $250. I've seen them $350, and it could take, 1 to 3 weeks.
Like a $250 or $350 fee to get this done? So like to ask their approval?
That is correct. Yeah.
Huh. So
that is pretty standard for all of, anybody that's in second lien position, but that is also something if I know it's rare, but there's also seasons of time where it's not as rare. I haven't done a subordination in probably 5 years, but 5 years ago, I probably did 6 of them in that year. So it's waves. It just depends upon where's the market rates, what's the trend of what's going on at that time. So be mindful, what is a subordination? It's going to the second mortgage and asking a new loan that's going to be recorded after them to have a higher seniority lien position.
Yeah.
Yeah. Technical, right?
Yeah.
The other thing too, just real quick, is for qualifying, it's pretty much many of the same guidelines as the first mortgage. How do we look at self-employment? Typically 2 years. What's the debt to income? There's always a debt to income ratio of what you qualify for. Because these are adjustable, we have to be a little bit more conservative because there could be a time where rates do go up. I'm not saying that's right now. Hopefully they just go down, but I'm saying, calm down, people. I'm just saying. So when they qualify, let's say your starting rate is 7.75. The standard protocol is to add 2% to that. So 9.75, what is that payment, principal and interest? And that's how we qualify. So it's a plus 2% start rate for qualifying. That's not meaning the rate that you're going to pay. It's just making sure that we haven't over leveraged that borrower. The rate can go up 2% and they still qualify with their income for the repayment of that loan. Okay. The other thing is the debt to income ratio on a first mortgage. Typically we can stretch it up to 50%. We're going to be a little bit more conservative, about 45%. So just a little bit lower there. So that's what I got. So I think we covered a lot of ground. We covered a lot of quirky nuances. I know that. And here's what I want to say, folks, is everybody's scenario is a little bit different. Right now, we're getting a ton of inquiries on the equity line. So we feel it's very valuable to share the information, go over the highlights just as we did. What we can offer you might be different, but now you know the questions to ask. How long is the loan? How long is the draw period? Do you have an early closure fee? What is my rate? What's my margin? You're now equipped to go out and ask those questions. So thank you for hopefully taking in 90% of that. We'll give you 50%, whatever it is. Now you understand more. You at least can walk away with one thing that you gained out of this. And that's what we're always looking to do, is gain your knowledge so you feel educated to go out, shop around, and get the right loan that's for you. We are always here to guide you. We're always here to give you our honest opinion and work with your goals, not just ours. So any questions, please give us a call. Feel free to reach out. Sarah, do I have anything else before I close it out?
No, but they probably should know where to call you at.
Oh, yeah. Well,
if you're going to tell people to call, they should know, right?
G-Money, you just Google that. If they're listening to this, they got my contact information. I'll
put I'll put our stuff in the notes.
No. Here we go. 805-667-8465. Yours truly may even answer the phone. So that's the office line. If you definitely want me to answer the phone, you call me on my cell and I will answer. 209-968-4641. If you'd like to email me, info@apmloan.com, or directly. Giving you direct access here, folks.
You're welcome, people. You're welcome.
Greg@apmloan.com. Boom. We got you all hooked up. All right. Until the next topic, until the next day, guest we have, thank you for joining us today. Thanks for listening. Like, share, subscribe, whatever they always tell you to do. Really, I don't care what my numbers are for this podcast. I'm just saying I do this for you guys because I want the information to be out there. As long as one person listens, I'm going to continue to do this.
Okay.
And I know there's a lot more than one listener.
There is more than one.
Yes. So I'm just sharing. This is how much I care about providing this information for you. This is Greg Abrams, if I can say my name, on G Money, real talk on everything mortgages and real estate. And Sarah and I, we are out.
Peace.
Peace.